All right, well, I've got 11:30 Central, so let's go ahead and kick this off. First of all, thanks everybody for joining us today. Again, I'm Mike Flaherty. I'm one of the partners here at AlphaCentric, and joined with me today is Jeff Malik from RCM Alternatives. Jeff works with our portfolio management team on portfolio construction and trade execution, and especially over the last week or so, this has become a more timely topic. We think that on how to leverage volatility to really help kind of three things to really kind of help manage volatility as both an offensive and defensive strategy in your portfolios, to improve risk-adjusted return across your entire portfolio, and really to help kind of navigate across kind of high correlation uh, market environments. So, Jeff, I know there's an awful lot going on. Let's just get right into it. Tell us what you've been seeing today, and let's look forward to a good call. We got some opportunities for Q&A here at the end via chat, and let's just go ahead and dive in. So, thank you.
Thanks, Mike. I was going to ask if you had more hair and darker hair before these last couple weeks.
Uh, yes, and yes.
Yeah, it's been fun. Uh, Wanted to start out before we get into the nitty-gritty of HMXIX, Premium Opportunity Fund. In my seat here, I deal with a lot of hedge funds, a lot of volatility traders, different players in the space, a lot of trend followers and CTAs. So just through a couple investor letters and chatting with traders yesterday, um, had some little analysis wanted to give you guys and girls from that. So, of course, we had the sell-off or approaching correction territory. I found interesting. Some of these guys are saying we're moving from the MAGA trade, US exceptionalism, to the mega trade, which is make Europe great again. So really this whole unwind over the last few weeks has kind of been seen as MAGA versus mega, which has been interesting. Some of the flow dynamics that some of these hedge funds are showing me is the institutional investors have been first to act. They're the ones, long short equity hedge funds, systematic CTA hedge funds. They've kind of sparked this sell-off. They're delevering. They're getting out of their equity positions. Interestingly, retail is still trying to buy the dip here with no signs of capitulation there. That was some of that. On a different note, a lot of these guys are saying, hey, was there any liquidity cascade? Were there any cracks in the foundation of the S&P, especially in terms of trade execution? They didn't see that whatsoever. Spreads are still narrow. Liquidity is still super deep. So kind of an orderly sell-off, not a panic sell-off so far. And that's it. It kind of we're saying this feels like a inflection point of kind of we've sold off the US, bought up Europe, and now everything's sort of at a base level and see where we go from there. One quick housekeeping note. This is a Zoom webinar, not a Zoom call, so the controls are a little bit different, but you should see in your control bar at the bottom of your screen a little Q&A button with a question mark. So if you click that and you can put in different put your questions and we can get them answered. So give me a second to pull my stuff up here. All right, Mike, you see my screen okay?
I can.
Full screen mode. All right, let's start it off. The fund has been around for a long time, since 2011. Used to be a private hedge fund that converted to a mutual fund. So over that time, 87% of years positive. I think that's one more than the S&P. 80% of months positive. It's 42% less volatile than the S&P. I believe that's about 14 versus 8.4. And it's 11% less volatile than the 60/40, which is 9.4 versus 8.4 for HMXIX. So really, we can talk through everything what it's doing, but really at the end of the day, what a lot of investors love about the fund is it just keeps kind of chugging along, doing what it does, putting up positive returns. So been a good run and happy to see it keep going. How does it do it? Four main components of the fund. The first and the kind of where Russ Colitis, the portfolio manager, where he cut his teeth and in his old private fund was a lot of option trading, some premium collection, some call spreads, some bull spreads. We don't need to get into inside baseball and how all that works, but suffice it to say, he's looking at the volatility curve. He's trading different option strategies around that. They're mostly all hedged. There's no naked short option exposure. So anytime he's putting on those trades, it usually has a offsetting short or long to it. So that's kind of, we'll go to the next page in a second, but that option income strategy is just designed to kind of be a tailwind. If we're tracking the S&P, add a little bit of extra income to that. We've seen a lot of that over the last 2 years of these so-called alternative income funds, which are essentially doing similar stuff, just trading options, generating income in different ways by either selling covered calls or different bull or bear spreads in the options. Secondly, because we're trading futures options, which don't require you to put up the entire value of the trade, we can hold about 70% of the fund's assets in cash. So we're earning T-bill interest there. So that's a nice tailwind over time. Third, as you can see in the annual table there, 2020, big return number, the VIX-based downside protection. So I think that is really what sets the fund apart from, whoops, sorry about that. Sets the fund apart from its competitors, has this growth potential with the income generation, but also this built-in mechanisms with the VIX where we can capture some downside. And then lastly, the market participation. So that's futures and options based. That will vary between 40 and 60, I'll say 40 and 70%, with the goal being capture upwards of 70% of market upside and capture right in a slow slog like 2022. You can see that's the downside of the program. In a slow slog downwards, hopefully we're going to cut that market loss in half. I will leave it there for a sec. I'll just note this 2025 is just through the end of last month. So it's slightly positive. We're down now a bit after yesterday and this month, but the year is early. Let's see. All right, so some of you people maybe get a little too technical with all this. I kind of like this chart. This is how my brain thinks of it. We have the 4-quadrant model that's been known, but really what that's saying is, okay, we have these different types of market. The top left here, we look to capture 50 to 70% of the market upside in a bull market. That's going to be your 2023, 2024, 19. Right? And that's that option participation and the long equity participation. So normal rallying market, we're looking to capture 50 to 70% of that. It'd be at the lower end of that range if some of the option strategies are seeing issues. Say there's some sharp downward moves that are quickly rebounded back. We call whipsaws, right? If there's a lot of whipsaw action that causes some of those option trade losses, and we have to put on more protection on those, you're going to see that towards the lower end of that range. If it's a smooth upward rising, it's going to be towards the higher end of that range. I'll go bottom left here now. The slow sideways market, we should look to have small positive returns because of that option trading income. So think of, right, selling covered calls, selling secured puts below the market. So both of those can just generate that option income returns in a slow sideways market, where the long futures participation in the equity markets won't really do much of anything. Back up to the right, look to flip the sign in a sharp stock sell-off. Say that 5 times fast. Sharp stock sell-off. That was 2020. You can see, and we'll get into more of how they do that in 2020. But March was pretty much perfect setup. VIX signaled a turn. We got the turn. We went severely long VIX, and that offset most all of the loss in the equity participation. So in such a sharp sell-off, we'll look to what we call flip the sign, which is basically take that market participation, flip it, and in a down market, we're actually posting positive returns. We saw in August of last year, we saw in this sell-off so far, that doesn't always happen. So the sharp stock sell-off is the key there. What exactly does that look like? Is it coming from a low VIX to a higher VIX? Is it going from a high VIX to a higher VIX? Some of those particulars, how that path dependency works out, will determine how much of that sign we can flip, if any. And then kind of the worst case scenario, right? There's always a risk to every program. The risk to this program is a slow down market like we saw in 22. So 22 was kind of a volatility list sell-off. It wasn't a sharp sell-off, right? We just went over time. I saw some data. If you bought I think the year started, call it at 5,000 in the S&P. If you bought that 5,000, or if you bought a 4,500 put, which was down 10%, that put actually lost value over the course of the year. It was so expensive at the beginning of the year. By the end of the year, even though the market had come down, it had actually lost value. So as we say, options is kind of 3D chess. You need both the direction and the timing correct. So the direction was correct there, but it took just too long for the value to accrue to it. So the fund will alternate and has different quadrants, right? It's looking at, is the market rising or falling? Is volatility rising or falling? So take those both on and off of each of those indicators, put that together, get a 4x4 grid of we're in up market rising volatility, up market falling volatility, down market rising volatility, down market falling volatility. And the model will put on its different positions as we oscillate between those 4 quadrants. March of 2020, want to know how we do that. How do we flip the sign? Russ isn't sitting there with a crystal ball. We're not looking at macro indicators or seeing what the Fed is doing. None of that is going on. It's a systematic model here that looks at mainly at the VIX curve. So again, this gets a little into the weeds, but right, there's VIX futures. It has a curve of the next month's futures are at one price. 6 months now is at another price. As you can see in this bottom left green corner here, it's typically shaped something like this. The front month's at 12.5 and the back months are at 18, simply because we don't know what's going to happen in the future. So future volatility is priced a little higher. So going up to the top of this chart, things were somewhat normal, even though there was COVID news coming out. Around end of February, more COVID news started to come out. Markets started to signal this is a worry, and the VIX curve went slightly above that front month. VIX went slightly above the further out months. And I kind of think of the VIX in this indicator as sort of, imagine you're on a naval vessel and you're looking at the radar, right? If a lot of people think there's any problem, it's going to spike the VIX. That's not necessarily the case. If I have 6 ships, enemy ships on my radar, but I know they're out there, those are existing blips on my radar. The VIX really spikes when I have a new blip on that radar, right? So something new is on my screen. I'm worried about that. I'm going to bid up my option prices. So even though there were some existing blips on the screen throughout Jan and most of Feb, some of the new data that came out in Feb there was basically a new blip on that radar. So essentially we're long in that quadrant, up market, down volatility. That first VIX signal said, hey, we're now in rising volatility up market. Let's move to a more market neutral stance. And then come February 24th, went to a significant inversion. And and then we went mostly long vol into that falling market, rising volatility. And then that survived for a couple weeks. And then it got so high that they started to become a falling market declining volatility signal, which got us out of that protection position. And how this generally works is you'll have, right, the VIX will increase many times more than the S&P will decrease. So we can have that long S&P plus the long VIX, right? If the VIX goes from 17 to 80, that's a 5x, right? Where the S&P might only lose, that's 500%, where the S&P was down, 18% over that time. So with a correct positioning size, we can capture that much greater up move while only losing that much on the downside. And hopefully I'm just going to check. I don't have my screen up, but if you have questions on that, throw them in the Q&A again.
Jeff, can you share with the audience kind of what quadrant you're in right now?
Yes, we're currently in the increasing volatility. So we're in this somewhere between this yellow and red, right? We've got that initial signal, but it hasn't quite gone to a major inversion yet,
Okay.
which was that on the screen you're seeing, that Feb 24, 2020. So we're somewhere between that Feb 21 and Feb 24. This has been a much slower, right? That inversion there kind of happened quickly in 3 days. This has been a slower moving conversion, so it's been a little bit more difficult to position and capture that. You can see that by the market's gone down 5% and the VIX has gone up like 30%. So it's kind of only a 5-to-1 versus a 500-to-1 move, or a 50-to-1 move.
All right, good. Thanks.
Yeah. Go back to so that's a lot of how it works. I wanted to touch base. We talked to a lot of people. I spend a lot of my time, used to run my own trend following program. So I kind of have trend following in my bones. I know a lot of investors have exposure to trend following, either through some of these blended products or as standalone products. So kind of called this a portfolio wonk's dream. Sorry if that offends anyone, but a lot of these people who are putting portfolios together who want a better Sharpe ratio, better Sortino ratio, which is return over drawdown, really love this combination. And this kind of shows how the fund works well in a portfolio. Like, it's plenty fine all by itself, but when you start adding it to different pieces of diversifiers, it really shows. So MBXIX is the trend component, HMXIX, the options vol component. You can see in each of those, all of its these are its 10 worst months over here, the Milburn programs. And then alongside of that, the AlphaCentric programs performance in those months. So in its worst 5, Milburn lost 8%. AlphaCentric did 3.5%, right, for an 11% difference, which is just crazy. And the worst 10, 6, and +1. So when you put those together, just a simple 50-50, you get this very nice combo where the drawdown is only 5%, or call it 6%, versus 14 for HMXIX alone and 31 for the Milburn program. And then we've seen this when some other groups have put the fund as a bond replacement, so they can replace their bonds. It's got much less drawdown, more upside than their bond component. So in 22, 23, that really shown. So I would encourage you to start throwing it in some portfolios and seeing how your stats come out, if you're a portfolio wonk like me, so to speak. And that's all I've got for now. We're going to go into Q&A. I'm going to stop my share for a minute. I'll start here. I got one question came in. Basically says, will you be doing anything different in managing the fund with the new administration? So, quick answer is no, right? Systematic, data-driven 4-quadrant model. So, and I'm not doing the managing of the fund either. That's Russ Kalitis, but he's using systematic model-driven 4-quadrant model. The investment decisions of that model are the actual market signals. They're not political predictions. And the strategy adapts automatically to those conditions. So it's going to adapt systematically based on what's happening, not anything like that. A little bit follow up to that, right when Trump 1.0 was a little bit different than Trump 2.0 here, even though we had that volatility, that was COVID, that was a unique set of circumstances. So this, yeah, it makes a direct comparison of what's happening now a little more difficult. All right, 2 more here. How do you distinguish between genuine market signals and mere noise when deciding to shift between offensive and defensive positions? Fantastic question. I think I'll reword that a little bit and just say you can't distinguish, right? Sometimes the signals are noise. So I think the best way to think about that is risk management. And if you get that signal, you're not going hog wild one way or the other, right? It's small incremental changes. And then you really need what we talked about. You need that VIX over S&P to go 50x, something like that, right? You need that big move because we're not putting on enough defensive positioning to work on a 2, 3, 4x move, right? It needs that 50x move. If we said, hey, we're going to protect every little drawdown in the S&P, every little signal, that's when I think we'd get in real trouble, right? Because you'd just be getting whipsaw on every little piece of noise. You would lose 2, 3, 4, 5%, just trying to hedge it, which becomes, you're kicking yourself in the foot at that point. So the whole game is put on as much protection as possible for as small a cost as possible. And really how you do that is to have as much, the statistical terms, convexity, but as much, pop in that hedge as possible. Another one here. Thank you for all the questions. Do you have the same sort of list you just showed for MBXIX with the SPX? I don't have it in our chart here, but we can send that to you. I'll forward Mike, who asked that question. And then Alexander, what indicators outside of traditional market metrics do you find most helpful in choosing offensive and defensive stance? I'd argue that perhaps what we're doing is already outside of the traditional market metrics. I think most people are looking at something like the Buffett indicator or PE ratios or CAPE ratios or, right, some sort of traditional earnings-based metrics and valuation metrics where we're not concerned one bit with the valuation metrics. We're not trying to necessarily buy low and sell high in the stock index itself. We're just trying to participate, have that kind of always on, and then wait to see what volatility is doing in order to adjust that positioning on either side. So I think it's more volatility-based indicators than traditional market indicators. And then I have one more here, which I'm going to paraphrase, but it's essentially how do you manage risk to smooth out the ride? Which it was giving a bunch of stats here, but like you have this lower volatility. How do you do that is essentially the question. Strict exposure limits, right? So we're not going to all of a sudden be 100% long S&P and short all these options where you could get over your skis. So leg 1, 2, that 3-layered protection strategy. You got the VIX-based hedges. We have option collars to define those risk boundaries, and then put spreads on the downside for just kind of something happens on a Sunday night or, over the weekend where, God forbid, there's a 9/11 or something. We have kind of those way, way out of the money puts 20, 30% out of the money if the market just spiked down on kind of a Black Monday type scenario. Mike, you got any other questions from your side or thoughts?
Yeah, Jeff, talk a little bit about, I think a lot of people are familiar with, kind of covered call funds. You talked a little bit about trend following. We're taking a different approach here with the options on the S&P and the VIX futures. If you're to kind of look at those kind of three buckets, if you will, how do you see people putting together wisely alternative type sleeves of their portfolio using those three components?
Yeah, I'll start with the covered call strategies. My personal opinion is those aren't very alternative at all,
Okay.
right? They're kind of neutering your equity exposure. So another way to do what they're doing would just be to own less equities and go own a bond fund or something. Like you're essentially doing the same thing by, right? If I'm in a covered call strategy, the market runs 30% and I called out and I only make 10% or whatnot, right? I could have just owned a third of the equity exposure. Those
Mm-hmm.
should do well, like we saw if you have this super flat market that's, up or down 5% in a year. Those should probably do well, but overall, I would just rather own less equities and do some other things like trend following, like volatility exposure, than just have everything in some covered call. Uh, Interesting, which I can share that quick again. The right that I don't have this on the slide, but the real difference between the trend following approach and the volatility approach, you can think of the volatility approach as kind of the first responder. So there's an emergency, VIX spikes, volatility traders, option traders are going to be kind of the first on the scene, right? They're trading that stuff day in, day out. They
Uh-huh.
have that, like we talked about, you have those puts way below the market. The market's down 20%. They're going to naturally, structurally increase in value. The trend followers need a little bit more luck, I would say, right? So, or definitely more time. So they're kind of the insurance company that comes in weeks to months after the accident to clean up and help. And they don't do, there's no magic. They're not having this short exposure. They just start to get into positions as the markets turn over and trend down, which is typically short equities trending lower and long fixed income, right? Because typically see a flight to safety in treasury bonds and whatnot. So they get long fixed income, short equities, and usually short commodities as well over that. But they're going to need, right? A lot of them struggled in COVID, like Milburn, because it was just too sharp of a downturn, right?
Uh-huh.
By the time things had started to turn over, mid-March, end of March, they got short all that stuff, and then it quickly revamped back, and they were caught on the wrong side. So a 22, great for trend followers, not great for us, right? That was a slow draw down where you had
Mm-hmm.
everything reversed. You're in all those positions, things are moving down. So that's to me why this combo works so well. You have the first responder, and then what's the first responder really bad at? A long extended drawdown. So what can you find to cover that long extended drawdown is trend following approaches.
Very good.
All right.
Do you have anything else on your end there, Jeff?
I don't think so. We're gonna send out the chat. We had some spammers sign up here. So if you don't get your lunch certificate, shoot us an email and we'll get it to you. But we didn't want to send some to a lot of these questionable Gmail addresses, but we should have been eating lunch here for the lunch and learn while talking.
Well, yeah, so thanks very much everybody for joining. We'll get all that cleaned up, and if you'd like to have some further dialogue, we will be sending some follow-up information. So you can reach out to me, you could reach out to Jeff, you can respond to the follow-up information, and we'll go ahead and get a hold of you. We're available for one-on-one conversations. And again, we realize that You probably get awful lot of opportunities to join events like this. So thanks for carving some time out to join ours. Hope it was worthwhile for you. And we look forward to talking with you here again in the future. So thanks and have a great rest of your day. Take care now.
Yeah, and thanks for the questions. Usually we get these and no one asks questions, so I appreciate the questions. All
Thanks
right.
again, folks.
Thanks, Mike.